We've got a great panel in front of us. The topic is access to capital. Again, it's a topic that is widely discussed, and we're going to be talking about strategies to fuel innovation and economic growth. Our moderator today is Shermaine Tilley, Managing Partner at CTI Life Sciences Fund. Shermaine is an absolute expert on this topic of access to capital. It's what she lives and breathes every day. We're very excited to have her here and lead this conversation and dialogue today around this important topic. Shermaine, the podium is yours.
Thank you, Jason, and to Life Sciences Ontario for organizing this and for inviting me to chair this session. We have a number of distinguished panelists here. I will just introduce myself briefly, and then we'll go around and let them do the same. As Jason said, I'm Managing Partner with CTI Life Sciences Fund. We are a Montreal-based fund that focuses on health-related life sciences, investing in drugs, medical devices. We've done one healthcare IT investment. If that one turns out to be decent, they may let me loose on some others. And we also would invest in tools-type companies that are developing novel technologies for use in pharma, biotech companies, et cetera. We have 245 million Canadian under management, and we are currently finishing off our Fund 2 and hope to raise a Fund 3. We invest all over Canada as well as in the US. So now, why don't you start down there, Michael, and we'll go along and each one of you can introduce yourselves.
Good morning, everyone. My name is Michael Kousaie. I'm one of the heads of business development at Toronto Stock Exchange and TSX Venture Exchange. I'm responsible for the work we do in broadly the innovation sectors and in attracting innovation companies to go public and managing and guiding them as they go through that process. For us, the innovation sectors include tech, as in ICT tech, clean tech, and life sciences. And as we'll talk about, I'm sure, a lot, sadly, the life sciences is the smallest of those three. Not out of any matter of sort of interest or preference, it just has become that way because of investor sentiment and so on. So we'll share a few perspectives on why that is and what we think is driving that, and most importantly, what kind of things can be done to change that.
Great. So Paul Manias from OMERS. As many of you know, OMERS is one of Ontario and Canada's largest pension plans. We've got over 90 billion in assets. Over a range of asset classes. I sit in a business unit called Platform Investments, and that business unit is responsible for really the innovation within the OMERS pension plan. We build new businesses in areas that OMERS wants to explore. About 7 or 8 years ago, we started a venture capital program focused on ICT, branded OMERS Ventures. It's been quite successful for us. We've had some nice exits, including interest in Shopify. And we've used that, frankly, internally to build on and sponsor other ideas backed by themes that we feel are interesting. Life sciences, when we started our venture program, was considered in 2010, but frankly, we made the decision as ultimately as stewards of capital and fiduciaries for our pension members that it wasn't an area we wanted to invest in. Less than a month ago, we received approval from our senior management team to re-examine the sector again. We think there's a number of, we can get into it later on, we think there's a number of green shoots. Don't want to overstate that, but a number of green shoots in the industry now, both in Canada and globally, that we think we can leverage into attractive return for our pensioners.
I'm Ryan Cook. I've built and sold a few companies, and today I'll probably talk more about as an investor in DNAstack and Mark Fumet. I met him through my wife, and while he was a student, and gave him $1 million to figure out a way to have an impact on genomics globally, and then hopefully figure out a business later. I guess it's been really great as the first company I built in Toronto. with Mark to see all the advantages of building here. He's built the largest genomic search engine in the world as part of the Global Alliance, and currently works with a lot of national precision medicine initiatives around the world. Sadly, we don't have one here in Canada, so that's the context I'll talk about.
Good morning, everyone. My name is Chris Walker. I'm a principal at HarbourVest Partners, located just downstairs on the 27th floor, so this was quite convenient. I've been at the firm for 19 years now, though we all function as generalists at our firm, investing in venture, buyout, and credit opportunities on the fund-of-fund side. I spend a good majority of my time on Canada as well as life science. For those of you who don't know HarbourVest, we've been around for over 35 years. We have a little over 400 people at our firm with 11 different offices all over the world. 3 different legs of the stool, fund of funds. We also do secondary opportunities, purchasing people's positions who are in limited partnerships or directly into companies. And we also co-invest directly into companies from general partners on our platform. So our latest office that we opened was Toronto. As I said before, a global firm, 11 different offices. We're involved in the VCAP program, with many of you I think are familiar with, which is the government's initiative to try and improve the venture ecosystem. So part of what that is investing into Canadian life science funds, tech funds, as well as co-invest opportunities.
Great. So it's often debated, the concerns in Ontario and Canada in general, that we are undercapitalized, certainly in the life sciences investment arena, both in terms of deal sizes and the absolute amount of capital available to us, as well as the size of Canadian venture funds, which typically do not stack up to the capitalization of U.S. venture funds. So I'd like just an initial take, because we'll get into some of the details later, from each of you, whether where you feel we should be spending the most effort in attracting more capital to Canadian life sciences companies. And could I start with you?
Sure. So what I'm going to bring to the perspective here is more of a global and specifically U.S. That's where I have focused most of my career, but now our initiative in Canada. So when we talk about things, the maturity of markets and where things are, I think there's a lot of great underpinning here. You know, when we talk about access to capital, people always think just throw money at it and it'll fix it. But the problem is with that, you know, especially from our side, where we have limited partners that we have to answer to, we're all focused about returns. And the simple thing is that when you create good returns, it tends to attract capital, and that whole sort of life cycle continues to happen. So, you know, it's interesting, it's called access to capital, but on the flip side, there's got to be all that, you know, stable platforms, there's got to be great exit environments. And I would say when you look at Canada, most of that underpinning is here. You know, people look at other emerging markets and have great GDP growth. It doesn't necessarily mean that that's where venture capital or life science is going to work. You need good exit markets. You need governments that are going to allow these exit and investment to happen cross-border. You need smart entrepreneurs who have done this once or twice before as well as smart general partners. So a lot of that underpinning is here in Canada. But again, I think it's that capital that gets these companies going, and then the general partners that continue to add value and invest in those. So we're at an interesting time where there is capital out there. There's more interest in this sector than I think ever before. But, you know, at least from our standpoint, it's got to translate into returns.
Ryan?
I think that the biggest thing for us is the amount of talent that's here and the value for the talent. The academic collaborators like Stephen Shear and David Malkin, research hospitals that you can work with, Global Alliance for Genomics being here in Toronto, large corporate partners like J Labs, Google, IBM, and supportive government programs like SHRED, OCE. That's been way more important for us than getting access to capital. We haven't had any trouble. After we first spoke, I took a bunch of meetings with some venture firms here. They were incredibly friendly. It was a lot less intimidating than New York or San Francisco. They were really generous with their advice and their connections, and they seem to have really deep industry knowledge. I think there's probably more capital here than there is good deal flow, honestly. As an investor, you look for those key things that's really helped DNAstack thrive. I think there's a 40% discount on valuation for sure. But I mean, for our business, we've had 18 inbound requests for information and meetings from international VCs, and we had one local request. So I don't think it's a problem to get money. I think you should have money from the US, from Canada, from Asia, hopefully. And I think the big issue that we're seeing is more with the way grants work here versus in the United States. So in Canada, we apply for a lot of grants through an academic collaborator. That ends up costing us money because we end up donating resources. For a startup, that's super difficult. An example in the States with the NIH, they do a precision medicine initiative. Industry can apply directly for it. So you have a company that's kind of a competitor to us called Seven Bridges. So they apply for this grant, they get some funding, and they do a $45 million A round. You can't blame a VC for not putting money into a company that has no traction, that has no revenue. This grant money is the perfect environment to springboard commercialization. And we really struggle with that to the point where we're going to open up an office in the US and in Europe and focus on countries where we can get funding for precision medicine initiatives. And it's unfortunate because we have the most genetic talent in the world.
Correct.
That's my experience.
Thank you. Paul?
Look, without repeating what's already been said, I think what's attracted OMERS to kind of return and relook at the sector is a lot of the fundamentals that Ryan mentioned, in Ontario and elsewhere in Canada. But to Chris's point, I mean, we are a big believer that good companies attract capital, and yes, there's always friction in the market. But the reality is, I think you need to look to the real set of market opportunities. I think one of the challenges within the Canadian and the Ontario ecosystem is that, we do, because of our grant mechanisms and a lot of the other government support mechanisms, which are, attractive at one stage, they become a bit of a crutch, I think, for some companies. And so you have at least in our initial view, kind of a zombie cohort of companies in the market that are there. And what it does is, it really, it skews your metrics on the attractiveness of the sector and the like, so overall, we do think that we see a lot of US VCs, certainly on the IT side where we're active now, looking to Canada and Ontario at almost every deal we compete for now, and colloquially, within the life sciences world, we see that already be the case here in Ontario. So access to capital kind of feels like a bit of a crutch argument for a lot of people. And look, this is not to say that there aren't challenges, individual challenges at every level for sure. And there's always going to be exception story where someone did really have something great and it got missed, but I mean, that's venture. Overall, I think that while we always need to be sensitive to access to capital, it is probably one of those issues we serve as an industry serve well to move off of and focus on other things.
Michael?
What I think I'll do is I'm just going to frame my remarks here in a couple of respects. First of all, by maybe looking at what some of the good news has been in the country around our shift to more of an innovation economy, and then drill just a little bit on some of the challenges that are unique to life sciences that I don't think have come up just yet in the conversation, but I think are perhaps one of the key reasons why this topic continues to be brought up. So if we just first of all look at what's happened in our country around the shift to innovation, it's real. It is absolutely happening. You can measure it in many different ways, and industry organizations like LSO have got some great data on what's going on. You can look at it in terms of jobs. You can look at it in terms of venture capital funding coming into broader innovation sectors. All of them directionally are heading upwards and to the right, which is, of course, great for everyone. The lens that I look at things at, because I represent the stock exchange, also shows a very similar story, and it's actually quite a shocking story. You know, we tend to think that Canada is still a natural resource heavy economy, and yet when we look at it through the lens of the stock exchange, that's actually no longer the case at all. 5 years ago, mining and energy represented about 40% of the value on the stock exchange. Today, it's less than 20%. But the size of the pie has grown significantly over that last 5 years. And the beneficiaries of that have been growth-based sectors, including the tech sector, including clean tech, including life sciences, including media, but not clearly mining and energy. And so there is a shift that's absolutely happening. But back to where I began my comments as I sort of open things up, there's something unique about life sciences that does make it more difficult, I believe, for some investors. And that is the very specific science of life sciences and the fact that you need to be smarter than most to be able to figure it out. And I don't just mean smarter than most as in top of your class. I mean, you probably need a PhD in the specific science in question to be able to ascertain why one therapy is better than another. And that's a distinction that makes it very different from other investing verticals. And it's not to say it's quote unquote easy to invest in ICT or easy to invest in clean tech, but it's easier to invest in those two things without having to go back to get your PhD in some really complicated molecular something or other. And I think that route makes it difficult for investors more than we maybe sometimes remember.
Interesting, thank you. So the one of the issues in our world as a venture investor in raising money within Canada is the fact that there is perhaps less pension fund involvement in a fund-of-funds context than in the U.S., although there is the option to, of course, raise outside of Canada with the understanding that U.S. investors often like to focus on the U.S. and the same in other jurisdictions. You know, I speak for myself and for probably much of the industry to say that we're very excited at the prospect that OMERS may leap into this area in a bigger way than they have before. So I'll bother you, Paul, to get your perspective on how you're feeling about that. And then each of you can comment on whether you think, which has always been a very controversial topic in Canada, whether pension funds should have any kind of economic incentive, either from the federal government or tax jurisdictions, et cetera, to invest in a specific area like life sciences, or should be left to basically focus on returns in a pure way.
Okay. So let me I'll touch on the topic separately. So on the first, as we start this journey, I do think there are, so as I said, we're looking at life sciences globally. We do think there are a lot of advantages in the Ontario market, the Canadian market, where, you know, the grounds are potentially very fertile to grow, you know, attractive life sciences companies. Many of those companies, I think, by nature of the product they create, are going to be, you know, either listed, hopefully here, or exited to, you know, to a multinational. So I think part of that, you know, we need to observe. But on the, you know, on the topic of how we are going to look to access the market, I think because of some of the comments that Michael made about, you know, the distinction between this and ICT being focused, you know, more heavily on science and in particular on kind of the binary risk associated with that. You know, I think life sciences is actually an area where, although we're very much a direct investor, we'll probably toe in to, you know, to participating more in funds more so than we otherwise would. So part of, and so I think that, you know, I think there's an area for that. Now will we look to, you know, potentially make investments in Canadian funds? Potentially, but I think there'll need to be a value proposition there. I think our view is that we can access Ontario, Quebec, you know, BC, Canadian life sciences companies through U.S. and international managers as easily as we can access them through Canadian-based managers. Now that said, I'm happy to be frankly proven wrong on that hypothesis if a particular manager in the geography is able to prove that they've got better network, better understanding, et cetera. Then there's a value proposition to us putting money to work in that area. On the second topic, which is incentives and should pension funds kind of be required to invest in certain sectors and the like, I would say the comparison's often made between the Ontario funds and the Quebec-based funds. The one distinction, which is an important one, is that with the Quebec funds are mandated through their legislation to consider both, at least some of them, like the case, to consider both economic returns as well as economic impact to the province. OMERS, is not an arm of the Ontario government, although Ontario is in our name. We are a separate entity. Our mandate is purely to provide our pension plan to our members. Certainly to the extent we can achieve both successful economic outcomes and economic activity in the province. We represent 500,000 Ontarians. That's a positive, but we have a very bright line within OMERS, as do many of the other Ontario plans. That it is returns first and foremost. That's a related point to the question, I think, on incentives, which is also interesting. I would argue the plans need no more or no less incentive than any other investor. So I don't think a special case should be made to say pension plans should get an economic incentive to do that, beyond the status that they're already accorded under law. But that said, I do think that this is a challenging market. Both, Michael put forward a very important point about the science. The other one I would make really relates to kind of use of capital. So, life sciences relative to ICT, and I put, I guess, clean tech on the life sciences bucket on this one, is capital intensive, has a longer period of gestation. That is harder to argue for putting your last dollar of capital into something like that than a business, like an ICT business, which can be turned relatively quickly for the same or greater return. Now, that said, we are of the belief at OMERS that we and the other pension plans have exactly that type of long-dated capital to pursue those opportunities. So the challenge, I think, with a lot of the other, with the other traditional VC market is that, they've got defined lives on their funds, and so there is a point in time at which they need to exit whether or not the company is ready for it. I think the advantage in bringing someone like an OMERS along is that we have the ability to work through those cycles. What we don't have the ability to do very clearly, though, is to work through those cycles and take a lower return. So happy to take a longer period of time, but we can't sacrifice return. And that, it seems fun it seems quite obvious, but you would be surprised how often that conversation comes up about, well, because you're a long-term investor, you can hold this asset for 20 years and you just need a 3% return or something of that nature. We're happy to hold an investment for 20 years as long as it meets our targeted return. Nothing would be better, frankly. So I've said enough.
Thank you. Michael?
I couldn't possibly add anything more to that.
Yeah, I'll add the following. I'm a big believer. When you look at the idea, because it's in your geography, you should fund it. I'm a big believer in pension plans should not be required at all to invest. I think all things being equal, if you have two equally good investment opportunities and one is in your geography, then absolutely support that. But you find that in the States. This happened many years ago where obviously we know it's a much more mature and sophisticated market down there. There were many states that tried to do this as well, economic incentives to invest, and those returns just didn't work out. And many have moved away from that. And capital is always going to flow to where the best investment opportunities are. And when you look at talk about incentives, and I'll use, for example, the VCAP program that we were speaking about before, you know, the government was interested in improving the venture ecosystem in Canada. We're not in that business. We're in the business of providing returns. So this has to be attractive for us to come into it. And that's with that VCAP program. The idea was, let's get private money in it. How do we do it? We can't force them to do it, but what can we put in place? And if those of you that aren't familiar, they put a fantastic waterfall in there with great downside protection for investors and then upside potential if it outperforms. So you actually had a lot of people look at this, go, I'm not sure how Canadian venture is going to perform, but I really like this waterfall. It's almost like a convertible security where, you know, if it outperforms, I'm going to, you know, get outsized returns, but on the flip side, great downside protection. So look at what we've done there. We've solved two of the issues here where you're getting private capital that's coming back into it, and the government is fulfilling their mandate of providing capital and getting private investors back in this. So, you know, we're in an industry that is long gestation cycles. It takes a long time, but at least this program that's been up and running now for 3 to 4 years, we have to see what the returns are going to look like. But if you look at just the structure and what it's done, it's absolutely accomplished this mission. And that's why there's talks of doing a follow-on program to this, because it's not going to be fixed in one cycle. It's going to take multi-cycles. So when we talk about incentives and attracting capital here, again, it's tough sometimes to get private capital to come in, but if you create incentives for them, as the government did with the VCAP program, you can bring and attract capital and start funding and getting that sort of ecosystem going off the ground.
Yeah, and I'm glad you mentioned the VCAP program because I think most of us feel that that has been a big success and are excited to see the federal government reinstate it, even though it's a different government and it'll have a different name. I think that's going to be just super. I just said that I was glad he mentioned the VCAP program because most people I know are very happy with it and feel that it's been a great initiative, and glad that the federal government, although it's a new government, will reinitiate a similar program with a slightly different name, perhaps Vicky or something like that. So that gets us into our next topic, which is the VCAP program has been mentioned, and also how we might do better, perhaps at a federal level, in terms of having larger grant initiatives that would be helpful. Are there other government initiatives, either from the Ontario government or federal government, that each of you would like to comment on in terms of something that could be done that isn't being done, or more could be done of? Michael?
The one that many in this room are familiar with and have been involved with trying to lobby the government for has been the flow-through treatment. This is something that will benefit public companies, but also just provide more capital to innovation generally. There's a long history of efforts to try to encourage the federal government to do this. As I said, many in this room have been involved, either individually as institutions or collectively as a group. And it hasn't, I think there's been an attentive audience to it, but obviously it hasn't yielded anything just yet. Our own efforts in exactly this field have yielded the same sort of responses, which is a willingness to listen, but not yet actions. And I'm sure that dialogue will continue for much longer, because I think many of us feel that could be an important catalyst to attracting more capital. It's been a catalyst to grow other sectors in Canada by providing the incentives for individual investors, retail investors, folks like all of us individually, to invest and get some favorable tax treatment for that. So I guess the jury on that one will remain outstanding for a little bit longer, but I'm sure others will keep pushing as we will.
So I don't have a specific request or idea, but in part because we're just starting our exploration in this sector. The one comment I would make, though, kind of relates to VCAP as well, is that, you know, these incentives drive behavior. Again, another obvious statement, but I think, you know, the agencies and entities granting these incentives or putting them forward should really give some thought as to what it is they're trying to achieve. So, for example, you know, I think the idea behind the VCAP program was very much, there's an underlying feeling of fostering innovation and technological advancement, but it was also done very clearly to resuscitate the venture capital industry in this country. And as Chris said, I think it's worked. It certainly worked quite well. We see a lot more competition these days than we did when we started our OMERS Ventures business in 2010 as a direct result of the VCAP, as well as other items like just the general success of the technology market in Canada. So I think as Greg and John were up here previously talking about all the various programs that Ontario has, all of which sound great, they all have a logical impact on the organization or on the industry. And I think we just need to be sensitive to what those are and ensure that the incentives that get put forward are trying to achieve a behavior that we really want and not other effects.
Right?
I think the big thing would be for the government to have a vision, a big one. I think we all remember when Obama and Biden essentially declared war on cancer. We have provincially fragmented, micro projects that aren't relevant on a global scale. I think it's really difficult if the government doesn't have a large vision, and then also, invest that capital the same way these people would, looking at a real return, because it's impossible. There's this whole cascade of value that happens when you have this large scale genomics project or anything else. I think the fact that the supercluster didn't really have a life science project in it is embarrassing. Definitely doesn't make me want to stay and hire more people here. That's the way an entrepreneur feels when they see the allocation of this capital. We have every factor, other than that here. We want to hire 50 people in a year. So I haven't heard a large vision for that. Nobody's said we're going to do something huge. Canada's going to be known for this. So that's kind of our concern, and we hope it changes.
So the only thing that I'll add, and again, I think the government initiatives are always helpful to really push that and drive, but the biggest thing is just talent and people. And there's a lot more now Canadians who have gone over to the States that are starting to come back. And so things that attract people and talent back home, or if they're not from here, the idea of I should go up there because it's a no-brainer with either R&D credits or tax initiatives, all these things that will make talent come here. If you get talent here, you will get people and you will get companies started. I think it's, it sounds very simple, but really I think that's what it boils down to, is attracting smart people who know how to do these things.
No, it's,
Sorry, just one more comment, because I think Chris raises an interesting point about bringing people back to Canada. I think one of the things we could also do, maybe as a kind of bold idea, is incent people to leave. And I know the guys in Ontario are gonna, I can see John going, what did you just say? But I actually think that if you think about and it's particular life sciences. So because so much of the life sciences business is global in nature, and it really still revolves around the U.S. primarily, Europe to a lesser extent right now, and in the next 20 odd years, likely China and maybe India. The ability for young people, either on the science field or on the business development side within life sciences, to leave the province, to leave the country, to experience business in those other areas, I think gives a level to the talent point. Really, I don't think anyone here would argue Canada and Ontario lacks basic science and attractive basic science. I think the real challenge we always hear about is how do you turn that basic science into not just a company of 5 or 10 people with maybe one small grant or struggling for some capital, but you really make it into a world-beating organization. We're not going to have 20 of those because we have to recognize Canada's role in the global ecosystem, but we can certainly have 1 or 2. But we can't do that without having talent that has lived through what it is to be, big pharma, big medical device company, et cetera, and then brought those learnings back. There's no substitution for living it. in my opinion.
Great point. This is certainly the greatest difficulty that we have as a Canadian venture fund wanting to invest in Canadian companies is the lack of seasoned management that has been there, done that, and that you can rely on to take the technology to the next level. One of the things that we've done is that we have connected our, let's say, first-time CEOs in Canada with a mentor CEO from the US who is willing to spend considerable time with that individual and say, when I was facing this problem in my company, or this problem going public, or this problem raising venture funds, I did this, and also willing to share their network as well as their expertise. But it remains a major issue. A couple of you mentioned the size of enterprises that we have in life sciences in Canada, and it's related to the lack of capitalization in some ways. But as venture funds, we do typically need to either sell off our portfolio companies to a larger company, or see them go public, either by accessing the TSX or doing a dual listing with TSX, New York Stock Exchange, for example, which our portfolio company Zymeworks did earlier this year. But we always hear the criticism that it's sad for Canada, also in terms of building that new management talent that we need in Canada to develop companies to a certain point and then sell them off. So there's always the discussion of whether we should do anything deliberate to foster the idea of having anchor companies in Canada in our space, from which these kinds of managers can train and come into then smaller enterprises. Would each of you like to comment on that, to what extent you think that's a problem or not, and whether you think we should be doing anything specific that we're not doing to foster that, if you think we should have bigger companies?
I guess from personal experience, building a business is super hard and very scary, and your emotions around the business changes every day. I've seen with, I was with Mark Andreessen and, Ben Horowitz, and the founder of Dropbox in Tokyo. And they were talking about how that grew, and it became so clear that it's really the investors that determine how the entrepreneur feels about growing and keeping it going. So let's say in the US, we go to a bunch of VC meetings and they're talking about a $20 million round. And we're like, whoa, we want to do like 5. And then we come locally and we're getting kind of, 1.5 million should be good. Well, so take that to like a B or a C level where the founder is going to make $20, $50 million guaranteed if he sells. And the investors are kind of like, really being on their case, versus an investor who's like, let's make this bigger than Uber. I think that companies and how fast they grow and how large they grow are determined by the attitude of the investors, how bullish they are, how risk averse are their LPs. And I think that you really need to look at your venture firm before you take their money and say, okay, what do you want to do here? Do you want to change the world? Do you want to be Google? Or do you want me just to get you the 5 or 10x and then we're friends and do it again? And I think that's a really great conversation to have with investors. And entrepreneurs will need their venture firm to be their biggest advocate and push them to do greater things than they feel that they can. That's how I always felt.
I think a lot of the challenges that we're talking about now, 7 years ago, 5 or 7 years ago, we might have had the exact same conversation around technology, ICT tech. And today that conversation isn't quite as relevant because something's happened in this last 5 or 7 years in that sphere of technology. There's been a bit of an arrogance in a good way forming within Canada, confidence by founders and ability to realize, we can actually build leaders in this country. And probably the single biggest catalyst for that was in 2015 when Shopify decided to go public rather than sell themselves. And in the span of the 2 years since they've been public, they've grown themselves from a $1 billion company to a $12 billion company today. And the sort of confidence that that exudes and the success that one really big success can, the lessons that one really big success can pass on to others is hugely important. And that comes, as I said, with a sort of swagger or arrogance or confidence that we can do that here. And I promise you now, when I'm talking to tech companies across the country, there's much more of a sense that we're going to build a business to last, not to sell. And that is a great story. It's a great soundbite to hear, and it's a great story. So how do we get to the same place with life sciences? Part of it will be a matter of time. Like I said, I think 7 years ago, we would have had these same conversations around tech, and it's now less important. Part of it is around nurturing the leaders and looking to a company maybe like Zymeworks to be that leader, or maybe it's another company to be that leader, to say we aren't going to sell out, but we're going to do this. But I do think in many respects there's nothing specific that we can do other than be patient and nurture some of these founders and try to inspire them to see the potential before they sell to whoever the strategic buyer is.
I mean, to Michael's point, I would agree. I think, you know, what we can do maybe in a general sense is celebrate those successes. You know, certainly, you know, Shopify was great for OMERS, and you know, but also great for the founders and the employees. So while still early days, you know, some have now started to leave, and you know, given both their age and stage, but also I think a conscious, you know, modeling of behaviors in the Valley in the U.S. They've now gone on to do new things. I think one of the challenges I think that we have in Canada is that I think we tend to be happy with kind of just above average. And so I think for many entrepreneurs, and this really isn't life sciences only, but I think, you know, one successful exit, so to Michael's point about, you know, selling out to the strategic, that's kind of all they need to do. And then they've checked the box and they buy a nice home and a cottage and they're all set. I think, you know, we've seen the model certainly in the U.S., and I spent a number of years in Boston before, you know, coming back home here. You know, you had teams who would make a real business out of, even on the life sciences side, you know, developing a business in 5 to 7 years, selling it, and off to the next one. And, you know, it was not, there was never really, you know, until you got into the late stages of your life, that you really ever thought about, now I'm going to take my chips off the table and go home. Now, you probably changed your role, you know, someone who was a chief scientist in one, you know, or maybe, you know, not even the chief scientist at the first stage, became a chief scientist, then maybe, you know, took a stint as an operations person, even a CEO. So things evolve. But the point is, within Canada, I think we look at, well, 2 points really. I think one is we look at exits to strategics as necessarily bad, and I don't think they're necessarily bad if we can recycle our talent efficiently. And the second is, I really do think, in a general sense, we kind of are happy when we do just above average, and that's not good enough.
To your point about that, Lawrence Lenehan and Rick Heitzman at FirstMark, that really were great VCs behind Shopify. I know them pretty well, and you'd be so embarrassed to ever pitch them or talk to them about an idea that wasn't going to be a tectonic shift in the world. And just pitching to them makes you more confident and to think differently. And I think that that's a big reason why, you know, they went from Canada, they went to FirstMark, they invested Pinterest. They're incredible people, and I think they really drove them to believe in what they were capable of, because it generally doesn't happen unless you're a complete narcissist. It doesn't come from inside. Somebody saying, you know, think 10 times bigger, and we can do it together, and I'm excited to lead this next round, which is 3 times bigger than what you expected.
The only thing I'll add to that, hitting on that point of holding out for the big home run, this is a very hard thing to do, and Ryan and others have tried it, where just starting a business to be able to get it successful enough to either go public or be acquired is difficult enough. Many failures occur before that happens. So the idea of a first-time team holding out and creating a billion-dollar company. I mean, the odds of that are astronomical. And that's why, to get back to the point before, is repeat entrepreneurs. They've done this already. They've had maybe an exit before. They know how to do this. That's where these big home runs come from, because they've done this. They can really speed up the timeline of what it is, because they've done it before. They've worked with VCs. They know the exit market. They know the strategics. So it really comes back from, rather than selling your company for $50 million and buying a cottage and retiring, is, hey, we've already done this. I can't tell you how many entrepreneurs there are in the Valley, which Ryan knows and sees. They never have to work another day in their life, but they're so hungry and motivated to start another business. And that's where that big wealth comes from, not only in starting these businesses, but that self-satisfaction. I mean, if I was some of these people, I'd never work another day in my life. But you get these people who are so hungry. You hear people, I can only play golf for a couple years so long. I'd like to try that and see if I can think of it. But that's what many of these people do. That's where they are just so motivated and driven, is to say, let's do it all again.
Chris, you just mentioned something which I think is so important, which is about the inspiration of the Valley. One of the things that I believe has been really critical to the success of the tech sector is an industry organization that OMERS has been involved with, based in Silicon Valley, called C100. Just a quick show of hands, anyone familiar with it? Yeah, pretty good. Okay, so it's a bunch of roughly 100 Canadian expats in Silicon Valley who got together in 2010, led by 2 or 3 VCs at the time, and said, we want to help inspire and build the next generation of billion-dollar tech companies in Canada. And key to their success is going to be accessing this unique community in the Valley, the community that provides capital, the community that provides talent, and the community that provides customers. And so this group got together and formed a not-for-profit that mentors and supports and guides these businesses. And they brought a bunch of people on board early, like us, to be a supporter of it. And they got Shopify, for example, as an early advocate and supporter for this. And while I know it hasn't single-handedly been the cure for Canadian tech, of course it hasn't, it has been a hugely important resource for many, many, many Canadian tech companies to get that access and to get that inspiration and to have the benefit of being able to tap into really, really smart, inspirational people from the Valley who have done this before. And the added bonus is they're Canadian, so they get the unique things that we all as Canadians have. And it's been such a powerful tool that, as a life sciences organization, maybe we think about, is there something similar? Is there a core group out of Boston or a core group out of whatever of Canadian expats who want to band together and say the same thing? We want to see these next businesses get built in Canada, and we've done it before, so we're going to help you.
Now, there is discussion around putting something like that together. Hopefully it'll actually fly for life sciences. Did you want to say something else, Ryan?
I was just going to say about first-time founders. I met Mark when he was still a student. From the beginning, he was 20 times better as a CEO than I ever was. I think Mark Zuckerberg, Drew Houston, a lot of these folks, maybe not in life sciences, but as long as you wrap a team around a first-time founder, so they don't get hit by the bus that is out there, it's okay, and you'll get a hunger that's different. And I agree with you about people that don't have to work again. They generally aren't becoming the CEOs. They're providing initial capital, but they're also, it's hard to put in the 80 hours a week after you're done. So that's the only thing, is you can make a first-time founder better than an experienced one with just a little, TLC. He's the best.
Just to that point, I mean, I think Ryan, you mentioned who your backer is, who your venture capitalist is, or other angel or the like, really makes a difference, because the ability to understand what people bring to the table and how you need to supplement them, is important. And there are different views to it, and one approach may not be right, but it will turn on the characteristics of you and your team and the venture capitalists that you bring to the table.
Great. So another source of capital for Ontario and Canada life sciences efforts is obviously private capital, and certainly from big players like Bayer, that have come in recently, and J&J and J Labs, we are starting to see more of this. Do any of you have perspectives on how we can foster more of that, and any specific efforts we can make toward that?
I mean, I think they're all coming up here because you pay 50% for an engineer. It's an incredible place to be. We're seeing a lot of people that live in the United States that are wanting to apply for jobs in Canada just because of the political situation they're not happy with, which I can understand. J Labs has been brilliant for us. They've been incredible. Tons of introductions, great office space, super supportive, helping us develop the product. I think Google also, I mean, unbelievable. I think it goes back to the grants. For example, Google is a platform partner for the Precision Medicine Initiative in the States. They've gone out of their way to do data sovereignty in Canada. Yet it's like pulling teeth. You get Google and they want to be the backbone of this infrastructure, and it's really hard to collaborate with the government. So I think if the government takes a step in that sense, then you're going to have a ton of people flocking here. Or that's what we've heard, is if it's easier for them to engage.
There's a great dynamic going on in the life science industry where we're seeing the corporates come in. We all know that many of them R&D departments have been decimated, and they're really looking much more to working with VCs at a very early point in life, rather than build something, we'll see if I like it. The conversations are happening saying with the VCs is, what areas are you very interested in? And do you want to partner with us at an earlier point in time? So you're seeing these strategics come in, providing non-dilutive capital, and that way there's a clear path to where these exit is going to occur. So really shorten the timelines. And not only that, the ability for these companies to exit, where they're getting a nice initial kind of 4 to 5x hit on the first time, with all these tangible milestones that are more near-term than long-term, where you can turn this in from a 5x to a 10x. That really speeds up the timeline. So, essentially you're identifying your buyer right away, and you know what they're looking for. And if it's a multi-platform where there's other, drugs and initiatives, so that has worked out really well in shortening timelines and having a better dialogue with the strategics.
I'd say, Frank, that was one of the reasons why we've kind of now relooked at life sciences, because we do think that that's a shift that's pretty secular in nature, that at least for the medium term, large pharma isn't going to rebuild their R&D departments. And so the idea of accessing IP, from a broader organization, i.e., startup and scale up companies, is going to be just part of the business going forward. And so that is again going to incent better exits and the like. So we think that's a structural change in the market.
I like that. Venture capital is an R&D platform for a lot of these companies that is not their core competency. I think that'll be huge.
And finally, are there any policies that we haven't touched on from government that could be helpful if you feel there's anything we've left out that could be done to help our industry?
I can just start off and maybe flag something that could be interesting background reading for anyone who wants to dig a bit deeper into things. About 12 months ago, we funded something called the TMX Innovation Roundtable, which was specifically targeted at identifying some of the funding challenges facing the innovation sector in Canada. And we wanted to do this a little bit differently from some of these other sort of white paper things that often float around and accumulate dust on a desk. And so while we funded it, we stayed away from actually being involved specifically in guiding the recommendations, because we didn't want it to have that bias. But importantly, the roundtable members were 12 people, all who wrote checks. So it was the pension funds, institutional asset managers, a couple of key other institutional investors, insurance companies, and so on. And so we put the challenge to them to say, what can be done? You write the checks, what can be done? And they came out with a series of, I think, very helpful recommendations. But I think the power, again, in those recommendations is that they were coming from people who write the checks. And so anyone who wants to read it, you can see the whole 50 or 70 page report on our website. Just look up TMX Innovation Roundtable. But the core of it was a specific call to action that these fund managers put out saying, we should empower ourselves or try to empower ourselves to invest a certain dollar amount in innovation, whether it's publicly or privately, doesn't matter. It should be done. And there were a few key targets that they put out, which I think is great. And the role now is to follow up and make sure that that action is happening. There are also a few other recommendations to copy, steal, mimic ideas that have been done in other markets, including some interesting innovations out of the UK to encourage investing in innovation. Same sort of thing, this committee or group got together and thought, there's some neat stuff here that we can replicate as well. And we're glad to see this. There were also some challenges put to the stock exchange to do things as well to encourage investing in both early and late stage innovation companies that we are also taking to heart and have started to execute on and try in terms of making it easier for companies to access public funding and easier for investors to figure out some of the stuff around investing in smaller cap companies. So just some food for thought for folks to maybe take a closer look at if you're in the policy sphere and want to see some of the thinking that's been going on.
One thing we spoke about before is the incentives and having government involved, and we know that capital is going to flow to opportunities, and if it's where we want to take this to the next level on life science, the one thing about the VCAP program, so we've been involved in initiatives like this all over the world, and the VCAP was modeled after Israel, where they came in and funded companies. When you look at the innovation that's occurring over in Israel, which comparably, is quite a small market, incredibly successful. And the reason why that worked and the reason why we've seen it not work with other initiatives is the idea of we're going to provide capital, but let's put it in smart people's hand and let them sort it out. Let's have very few impediments or requirements, and let's just a market-driven approach that will create good returns. And so I applaud the government's role in rolling this out because, at first we kind of just rolled our eyes and said, another government-led initiative, because we were expecting the same thing. So the government was able to provide that capital, create a good waterfall, and then let the four managers really craft an agreement that worked out both for them as well as us and allowed us the ability to create outsized returns. So it's the idea of not only providing capital, yes, this is your initiative, but don't put a lot of impediments on it either. Let the market drive what this thing is going to look like.
Good. Okay, so at this point, we will open it up to the audience for any questions or topics that you'd like to go on. Hey, Ila.
Hi there. So I actually have a comment and then a question. So a comment is there is an organization in San Francisco. It's called CELS. It's brand new, and it's actually run by Joanne Fedeko, who a lot of you probably know, who was the executive director of C100. So I think they've officially launched, and so I think they'll have some programming coming up, and I think that, as an example, you're quite right, I think that'd be great. There's also one in Boston called SEEN, right? So there are these organizations. We just need to figure out a way to make use of them, and so we should. So my question actually is, so I'm executive director of TO Health. We are promoting Toronto's region's life sciences sector, health sciences sector, and we keep talking about successes. So we want to promote successes. We want to talk about successes in Toronto and Canada. And I'm having a really hard time defining successes, right? Like everybody asks, what are our successes? I really would love to hear your definition of what a success that we should be promoting in health sciences is.
Would anyone like to start? I can make a couple of comments. In our world, it is related to raising funds. So if you raise a significant round of capital, that's some level of success. And in particular, if you're able to raise funds from outside of Canada, that's a success. If you're able to have a good exit for your investors and management, that is a good success. And obviously, if you can get drugs developed or get them on the market, or medical devices that are meaningful for the world as a whole and manage not to go bankrupt, that's another level of success. Okay, so please. Yeah. Anyone else?
I agree.
I definitely agree with that. but also I think if you look at usage, so if you have some startups or some mid-sized companies and they start, getting a lot of users, I'm thinking about it more from an infrastructure standpoint or open source, or some big partnership, something very kind of tactical to the business. I find that gets a lot of interest in the space or in the company.
I would look. I'm going to give the obvious answer, but for OMERS, it's return. So it's cash on cash return. It's either a successful IPO where at a period of time we're then able to hold the stock or ultimately dispose of it, or it's a sale to a strategic sale or licensing arrangement. But it is financial return. I think a lot of the things we talk about, about how to make the ecosystem better and all that, really relates to seeding the next generation of investments for us to make that same level of return on for it. Again, as a citizen, as a taxpayer here, obviously I want to see the province do well, and but as an OMERS person, it is purely financial return driven.
Yes. Jason?
Told you, this is like Christmas for me. I'm always going to have a question. So I actually want to ask your opinion, and this is kind of a broad question for all panelists, on two policy initiatives that have been talked about a fair bit within government related to access to capital. One that was discussed late in the tenure of former Premier McGuinty was an angel tax credit. We know that British Columbia has an angel tax credit, and they have quite a vibrant angel community in regards to life sciences. And I would argue that BC is probably punched above its weight in this sector. Now, is that directly related to the angel tax credit and the environment they have? I don't know if I can make that correlation, but I'd be interested to hear your thoughts. The second one is what Michael mentioned about flow-through shares, which has been advocated for such a long time. Chris, you touched on the importance of having a robust exit market, and that could be from strategics or it could be from IPOs. And immediately it was brought to a joint IPO. There is lots of money on the TSX, but Michael has pointed out life sciences is one of those least invested in sectors. So if there was an ability to increase the capital available on our TSX markets, would that improve things across the board by having a more robust exit pathway? So those are my two questions.
Who wants to comment on those?
The angel one gets me very excited. I think if there was any way that there was a tax benefit to doing that, when I kind of got out of building companies full time, I thought, there's a lot of angel networks that they personally invest, say, $2 to $6 million a year. If there was any way to encourage that, because it's a very high risk, but I think it would just explode. And a lot of times it's easier to raise money from family offices and angel investors for the first, let's say, $3 to $5 million of capital. We've found before there's real product traction.
Mm-hmm.
We all know especially on biotech, the window's open, companies go public, and then the window shuts. And there's a lot of M&A that happens along the way there. So a more continuous market, I'm not sure how you do that, but more continuous market with the idea of going public, whether it be, for many of these, they're just financing events. They're not full exits anyway.
Correct.
They still may be in trials. So the idea of it is a known way that people will be able to access different points of capital besides the private. But again, if you're going to do that, you can't be a single product binary event, because you go public and things don't work out on that one item that you have, one product, you're done. So it's the idea of different times, different points in the trial, multi-product, and it looks like a sustainable company. But again, going after big markets as well.
I like the angel investment tax credit. We have benefited from that being in place in British Columbia. Again, in the case of Zymeworks, in the early days, it was tough. It was 2009, and people were still reeling from all the capital markets issues. We were the only venture investor in the company, and if we had not had major angel investment, we could not have sustained that company.
So maybe I'll take the counter on that one. I mean, I think generally, again, incentives drive behavior, and so you will get more capital flowing into the sector, which for more capital light life sciences companies or really early stage companies, I think there will be some positive effect. I guess part of the challenge I see, and I don't know the market that well yet, so I'm probably speaking a little bit out of turn, but my sense is, again, there's just more capital needed to really bring these companies to a point at which you know, a sale or an IPO is tenable. My worry is that we are going to finance another cohort of zombie-ish companies that get a couple $1 million and kind of play around with things, but then don't really get to the the level that we need them to. I mean, I think we need as much a fast fail ethos in this in this country.
Agreed. Okay. Anyone else?
Yeah, question. So everybody here is talking about money, you know, raising funds, et cetera. And I heard somebody mention how do you measure success? And I heard everything that had to do with, you know, launching a product, et cetera. You know, so I'm wondering, does revenue matter anymore and profitability? I don't hear a lot of that. And does it matter? And is it considered in the valuation or anything?
Revenue certainly matters for med tech companies and for healthcare IT-related companies. In drug development companies, it is usually something that you see at a very, very late stage where we have simply not developed companies to that level in Canada. And so it is largely irrelevant, I would say.
Great.
You guys want to comment further?
Profits don't seem to matter much or at all. Particularly if you don't have revenues, you're not going to have profits. But even if you do have revenue, as long as you are a growth-based business, the investor community, I think both VC and certainly public markets, and I can look through that as long as you're growing or developing new drugs or whatever your business market is, that seems to be less important.
And there's fundamentally different structures of financing. So in addition to what we're doing in the OMERS platform side, looking at kind of the earlier stage, you know, we have a drug royalty kind of financing business, which enables some of those companies who are able to get you know to those places either directly or indirectly through a licensing arrangement with big pharma. You know, there's a ready source of financing and capital there, but that's different, I think, than what any of us are really talking about here.
I think revenue and profitability is definitely always a long-term goal. For us, it's at the moment revenue is tertiary, and our investors share that same belief. Because a lot of times you have to. I mean, if Facebook charged everybody $1 who registered in the beginning, would it be the Facebook today? So I think a lot of these companies, when it's 3 to 5 years of real risk when you're not focused on revenue and you're focused on traction and you're focused on discoveries. And I think finding people that don't rush you to make revenue a priority can really be critical for a company that's in a high growth market where market share makes a much bigger difference than short-term profitability.
If this was a tech-focused discussion, it'd be a very different answer. You saw many companies try and go public and actually did go public off of just the business model during the bubble with no revenues, not even a team, and going for a couple $100 million valuations, and we see what happened there. The good dynamic for private investors, for those of you that are either considering investing, whether you're a corporate pension plan, endowment, foundation, or you sit on boards, there's a lot of interest investing in specifically venture capital and buyouts, because the one dynamic in venture that we're seeing, which is very different than last decade, is the idea that these companies are staying private a lot longer. So you look at the dynamics of something like Google when they went public, the valuation that they went at and where they are now is just incredibly different. And that's really benefited the private investors because it's returns that are in the private markets versus in the public side as well. I mean, who would have ever thought Uber, you know, this is is it 60 billion? Is it 80 billion? Who knows? But that's a lot of money for a still private company. And the private investors are benefiting from that. So it really is the idea of there's got to be revenues, there's got to be traction, there's got to be, and you know what? It's okay. We don't have to go public right away. Let's ride this thing and wait for the most opportune time. And no offense, Michael, but a lot of these CEOs don't necessarily want to be a CEO of a public company. They want to go and do this and then get off the board and then go do something else all over again. So.
Yes.
Actually, that relates to my question about public-private. The late Adam Chwaniak and some other tech entrepreneurs looked at the TSX, and a lot of companies, entrepreneurs, not just investors, but entrepreneurs were looking at going public as their valued exit. On the TSX, because it was a resource-based index at the time, there was this 40% discount, so they were being picked off by American companies, and then the policy people were really worried because we were losing all these companies. When you said that the TSX has changed from 40% to now only 20% natural resources base, have you seen a change in the valuations on the companies that do go public on the TSX? Or should we keep advising our entrepreneurs to stay private or to go public, wait and go public on south of the border?
What we've seen is the valuation discount that used to exist for tech is gone. And indeed, in many cases, there's a premium. So we've got, I'll point back to Shopify as an example. It trades as the highest value software company in North America. And near the top of the list is another Ottawa-based software company called Kinaxis. Now, part of the reason for that is those are two fantastically performing companies, and good performance yields high multiples. But a second driver has been, for the most part, a scarcity. Is that what you were going to say? Yeah. There's been a scarcity of good product. And so when the product has come out, whether it's Shopify going public or other tech businesses or indeed sort of other non-resource companies, there's so much demand that it's driving the valuations up. That's great. That's great for Canadian companies and so on. And so that scarcity and that sort of dark decade has actually helped us today because the money's there waiting for it.
We talk a lot today about the innovation in the sector itself, but when I talk to large corporates, they're often thinking about innovation in funding and financing and investing. And we've seen deals like that, Arteis and Lilly as an example. Do you see the Canadian investor landscape changing to become a little bit more creative? Are they already creative? Are there impediments to that creativity?
Interesting. I hate to come back to the same theme over and over again, but probably the lack of capital is part of the reason that, Canadian VCs are not as entrepreneurial as they should be or as risk-taking as they should be. But it also correlates with our investors and what our investors are willing to tolerate in terms of volatility in our own funds. So I think we struggle with both of those things, but it's not for lack of trying.
I'd say there actually is a lot of innovation, but it probably isn't at the VC stage of the market. So if I look at what we or some of our peers have done, R&D co-financing arrangements, a lot of kind of off-balance sheet stuff that accomplishes the goals of big pharma traditionally and us as well at structuring, structured products, not in the sense of the, CLO squared stuff in 2007, 2008, but structuring outcomes on a private basis has taken on a much bigger role within our organization. I know that to be the case for our peers in Ontario as well, in large part because it's a low return environment right now, and so we are seeking to manufacture yields. And I think we're also, as a pension industry, I think we're becoming more cognizant of where we can drive value, what our competitive advantage is, and it is often in an ability to write, a large check around a structured, complex piece of paper that is just hard to kind of go through a traditional public markets channel on.
Anyone else? Well, with that, we will wrap it up. Start thinking about lunch and good stuff like that.